Afternoon, ladies and gentlemen. Welcome to this Monday afternoon's presentation of the Introduction to Weekly Options. As many of you read in the sign-up presentation or the general information on the webinar, today we are going to just discuss a history of weekly options. We're going to talk a little bit about the rights and obligations, and then we're going to go into some strategy discussion and use of the Power Options tools to help identify the weekly options on the various securities. If you have any questions during the presentation, please feel free to send them to me. I am going to try to leave 10 or 15 minutes at the end of the presentation to handle questions, so if you can, hold your questions until the end and then we'll take care of them there. But if you do have a question on something I'm reviewing or going over, then go ahead and just use the question pod there to send me a question. If I can't get to it right away, one of the other staff members that is joining us on the webinar today will be able to answer your question. Well, let's go ahead and just get started. Let's go into our presentation. First, I just want to talk a little bit about myself. My name is Michael Chepka. I'm the Director of Options Education here at Power Options. I've been with Power Options for over 7 years now. I handle a lot of the free coaching sessions and education on the website. I've co-authored 2 books with Ernie Zerenner, one on naked puts and one on protective option strategies, married puts and collars. And we may be discussing a little bit on naked puts and collar spreads today in our weekly discussion. Power Options is a patented suite of tools that supports over 23 different option strategies. I am versed in all strategies on the site. However, I do not trade all strategies in my personal portfolio. Things such as iron butterflies, short straddles, short strangles, and naked calls, for example, don't match my personal risk-reward tolerance, so I don't trade them. Now, you may find it odd that I say that when we're starting a presentation on weekly options, but it's actually pertinent to the strategy discussion we're going to have in a little bit later on in the presentation, and we'll talk about that as well. Well, what are we going to be covering today? I'm going to go through a basic history of weekly options. We're going to touch briefly on, of course, the requirements and obligations of the different weekly options. Then we're going to discuss basic strategies used with the weekly options. Any strategy that you can trade with standard expiration options that expire on the 3rd Friday, you can trade with the weekly options. But what we're going to discuss is the strategies that I know a lot of the Power Options customers who are using weekly options will trade in their personal accounts, and their approach to using it, as well as what I'm going to try what I'm going to try doing in the near future as well when I see some opportunities. And of course, we're going to spend probably the last half of the presentation showing how to use the Power Options tools to identify the weekly option strategies, where you can find them, and in addition, of course, to using the portfolio tools just as you normally would with the regular strategies to help you with your weekly options. All right, well, let's get into the history of weekly options. Weekly options are basically the same as the standard expiration options. They have the same requirements and obligations on the underlying security. For example, a weekly option on Apple will represent 100 shares of Apple stock. If I sell a call, I have the same obligations I would have as if I sold a regular expiration option. If I buy a put option, for example, I have the same rights I would if I purchased excuse me, a standard put option on the index or security. Now, these were originally released on October 28, 2005. The only security that had weekly options that was released was the SPX, the S&P 500 index. Now, of course, because it's an index, the requirements were cash settlement. You wouldn't purchase 100 shares of SPX and then sell a call against it as a covered call, for example. Any of the rights and obligations were cash settled. And this particular one is also a Friday AM settlement, which means that the last time you could typically trade to close a call or sell to close a put, for example, would be on the Thursday before Friday expiration. Friday at 9:30 when the market opens, you cannot trade the index options anymore for the S&P and some of the other indexes as well. So really Thursday afternoon would be the last time to close or manage a position, and the settlement price usually came out on the index at 10 a.m. Now, shortly after that, through 2006, other weekly options were added to the indexes of the OEX, which is the S&P 100 index, it's American-style expiration, and then the XEO, which is a European-style S&P 100 index, and XSP, which is the S&P Mini SPX options. Later on, weeklies were added to the Dow Jones Industrial Average. Now going forward, just recently on June 4th, 2010, CBOE released weekly options on ETFs, SPY, the S&P 500 Spider, the Cubes, which mirror the NASDAQ 100 index, the 1/10th or 1/15th of the NASDAQ, DIA on the Diamonds ETF, which tracks the Dow Jones Index, and IWM, the iShares Russell 2000 Index ETF. Now, shortly after that, the weekly options were released for other ETFs such as FAS, FAZ, and GLD as well. And we'll go through a list of those very shortly. Now, on June 25th, 2010, if you were following the blog on Power Options, this is when the weekly options were released on 4 common stocks. So now, in addition to having the standard expiration on stocks such as Apple, Bank of America, British Petroleum, and Citigroup, we can now trade weekly options against them as well. This opens up a lot of doors for other management techniques and other possible strategies that you could use on the standard stocks. On July 16th, about a month later, 4 more common stocks were added weekly options, I should say. Amazon, Ford, Google, and Microsoft. And I have an asterisk next to Microsoft, and I'll explain why in just a short period of time. But on July 16th, there were weekly options available that expired on July 23rd. So we had 7 days essentially to trade weekly options on these 8 stocks. Last week, Thursday evening, right before Friday open, new weekly options were released on these 5 stocks: Barrick Gold, Baidu, Goldman Sachs, Potash, and ExxonMobil. So now we have a total of 12 stocks, 12 common stocks that have weekly options. Now, if you went through the simple math, you just noticed that I actually just reviewed 13 stocks. Well, why is that? Well, right now the current indexes that have weekly options are the Dow Jones and the SPX. Nope, forgot an S in there. So the Dow Jones Industrial Index and the S&P 500 Index, these are both AM settlement options. Of course, in their cash settlement, you don't convert into shares of the index. OEX and XEO, the S&P 100 Index and the S&P 100 Index European style expiration. Again, these are cash settled, so you don't trade shares or purchase shares of stock to cover a short call. As of July 23rd, 2010, last Friday, the current ETFs that offer weekly options are EEM, the iShares Emerging Markets, FAS, the Bull 3 times financial, so it moves 3 times in relationship to the financial ETFs. FAZ, of course, is the Bear 3X financial. GLD is the iShares Gold Trust. IWM, the Russell 2000 Index, the Cubes, SPY, and XLF, the financial sector Spider. And the common stocks that are listed now, the 12 common stocks that have weekly options are Apple, Barrick Gold, Amazon, Bank of America, Baidu, British Petroleum, Citigroup, Ford, Google, Goldman Sachs, Potash Corporation of Saskatchewan, and ExxonMobil. Well, what happened to Microsoft? Well, I'm not really sure what happened to Microsoft. Microsoft had weekly options available on July 16th. They expired 7 days later on July 23rd, on Friday. When the first series expired, a new series has not been released. And I'm currently looking for information as to who made the decision or what was decided why Microsoft would no longer have weekly options, why it appears to just have been a one-time series from July 16th to July 23rd. Now, for an Excel spreadsheet with the listing of available weekly options, you can just follow this link. We might email this to you all later on in the after the presentation. CBOE.com, www.cboe.com/micro/weeklies introduction.aspx. That page gives you a brief introduction in the weekly options, but there's a link there that will take you to that Excel spreadsheet, which gives you an updated listing of all the available stocks, ETFs, and indexes with weekly options. Now, as we discussed at the very beginning, your rights and obligations for weekly options are essentially the same. They typically represent 100 shares of the underlying. The exception there is just that the indexes are cash settled. Those 4 indexes we looked at, you don't per se buy shares of the index and then sell a call against it as a covered call. You just sell a call, and then if it was trading above that, you'd pay out the cash settlement. Or if you bought a call on the index and the stock moved up, then you do the cash settled requirement to get your profit. They expire at 4 p.m. on Friday. All of the ones on the common stocks and the ETFs, they have the same expiration as the third week option. And the exception, of course, is DJX and SPX, which are the Friday AM settlement weekly options. New weekly options are typically released the Thursday prior to the expiration of the next week, about 8 days prior. So as I mentioned, on July 16th, that new series came out for the expiration on July 23rd. Technically, the weekly options that are out right now were released after the close, right after the market close on Thursday the 22nd. So they're available first thing on Friday the 23rd, and they're going to expire on Friday, July 30th. They can be bought or sold as regular options, turned into spreads, done with leverage positions, for example. Anything you can do with standard options that expire on the third Friday of each month, or with leap options, you can do the same exact things for the weekly options as well. Okay? Now, typical strategies for weekly options, I'm assuming that's why most of us are here. That was just a brief history lesson. Before we go into this, I should mention that I attempted to contact CBOE last week, and what I was looking for was a schedule of upcoming stocks that were going to have weekly options. I'm assuming that potentially 2 weeks from now, as we get closer to August expiration, there's probably going to be another 4 stocks that are released where weekly options are available. I'm assuming as we get closer to September expiration, another 4, potentially another 8 stocks are going to be released. But I could not get a list from them of the schedule moving forward of when the new options are going to be coming out and what stocks they are going to be coming out on. So I'll keep looking for that, and if you follow the blog on Power Options, you'll be able to see updates when and if we know ahead of time what new stocks are going to have weekly options. All right, but when we're talking about the strategies for weekly options, we have to keep in mind one of the standard rules of options investing. When buying options or long strategies, such as trading a long call, a long put, maybe a long straddle or a long strangle, we are buying the options, speculating on an increase or a decrease in the stock price to make a profit, you want to look for further out expiration periods. This allows the underlying security to have more time to move in your desired direction. Now, you do pay more up front, but when you go further out in time, the cost per day is lower. And so, for example, if I look at the August option, at-the-money option right now on Apple, if I compare that to the same strike option 6 months out in time, I'm not going to pay 6 times the cost. It's almost like purchasing insurance. If I pay month by month by month for my insurance policy on my car, well, they might charge me $100 a month, so my total yearly premium would be $1,200. If I request to pay a semi-annual fee, they might only charge me $550 every 6 months, so my actual payment would be lower because I'm paying more up front, so I'd only have to pay $1,100 total for 12 months. And if I paid it all up front, they might give me a discount where I'm only paying $1,000 for the year, so I save $200 on my total insurance policy. Options typically work the same way. About 1 to 2% of the time, there will be a biotech stock potentially or some other stock where news has been released of an FDA approval that's coming out 4 or 5 months down the road, so the near-term options won't be affected, but the options that are 5 or 6 months out might have a higher implied volatility and actually be a higher price per day than the near-term ones. But this is a very small percentage of the time that that happens. With that being said, can you use weekly options for long strategies, for buying strategies, such as the long calls and the straddles? Well, it's not recommended, but it can be done. If I buy a short-term weekly call on Barrick Gold, for example, or Bank of America, I have 7 days for the stock to move in my desired direction to earn a profit. I've really cut my time frame for potential profit very short. Now, the trade-off with that, of course, is that it's going to be a lower cost. We typically won't recommend trading the weekly options for the long calls, long puts, long straddles, where you buy a call and buy a put at the same strike price, long strangles, buying a call and buying a put at different strike prices, or the protective strategies such as married puts and married calls, because you want to give yourself a longer time frame for the stock to move in your desired direction. It gives you a better probability of success when you're long an option and you have a longer time frame. As I mentioned, the problem with buy strategies, well, the actual benefit is when you're looking at the weekly option, naturally your true cost, the time value cost, is going to be much lower because it expires in 5 to 7 days. However, you get that very small time frame for the stock to move in your direction and make a profit, and your annualized cost per day will be much higher. If I'm buying a weekly option every 5 days, if I keep doing that over a 3-month period, I would have probably paid several points more, several dollars more than if I had just bought the same strike 3 months out to begin with. So when we're talking about the strategies that are mostly used for the weekly options, we're talking about the income generating strategies. Covered calls and covered puts, naked puts and naked calls, and the vertical spreads, bull put credits, bear call credit spreads, bull call debits, bear put debits, and even iron condors. Now I have an asterisk next to naked calls because I mentioned at the beginning of the presentation this is one of the strategies I do not trade myself because the risk-reward profile is too high. The risk in these naked calls position is essentially or theoretically unlimited because the stock can go up to infinity, and when you short a call, you want the stock to stay below your call strike price. That call expires worthless in a naked call position, and you keep the premium. However, if I'm looking at a $10 stock and I sold a $12.50 naked call, and for whatever reason the stock went up to 100, I'm now on the hook to buy shares of stock at the market price at $100 to sell at $12.50. So, I mean, looking at that, that's a $87.50 loss on a position. You can't afford to do that. Now, is it better to trade, if you're a naked calls trader, is it maybe better to use the weekly options on naked calls as opposed to the standard expiration? Well, it might be, because you have a shorter time frame, there's less time for the stock to move against you. I also don't trade covered puts because I typically don't short stock in my trading account. But these are the preferred strategies, the preferred income generating strategies that most of the clients I talk to who are using the weekly options will trade. The most popular would be the vertical spreads and the iron condors. Some investors are using covered calls, for example, and naked puts, but when the premium's too small, it might not be worth it depending on how many shares you're trading, or I should say how many contracts you're trading, and what your commission fees are. Well, those aren't the only income generating strategies. What about iron butterflies? Well, iron butterflies is similar to an iron condor, and an iron condor will combine a bull put credit spread and a bear call credit spread. So I'll have 2 short options that are out of the money and 2 long options, calls and puts, that are further out in time. With the iron butterflies, I'm going to sell a call and sell a put at the same strike price. So I'm trying to pinpoint a strike price. Now that's really hard to do, which is one of the reasons why I don't trade iron butterflies in my personal account. And I have a joke with the customers that call me up for a coaching session who are trading iron butterflies and short straddles. And I tell them, hey, if you're able to pinpoint a strike price with accuracy every month of where a stock or an index is going to be trading, you're probably not calling me for help. I should start calling you for help. It's really hard to just pinpoint a strike price. But now that we're not dealing with a standard expiration that might be 4 or 5 weeks out in time, depending when our previous expiration was, maybe it's easier to do the iron butterflies with a shorter time frame, 7 days. Something that can be done. It's not what I recommend doing. Short straddles, same as above. It's hard to pinpoint a strike price, but you have a shorter time frame now, so it might be easier to apply that trade with the weekly options. Now, short strangles, this is similar to the iron condor, but without the long wings on the outside. A short strangle, if I have a stock at 50, for example, I might sell the out-of-the-money 45 put and sell the out-of-the-money 55 call. As long as the stock stays below 55 and above 45, both my call and put would expire worthless and we keep the premium. The problem there is that if it really has a significant gap up or gap down, I don't have any protection on the outside wings on a short strangle. I technically have infinite risk on the upside and the downside, although I do have a wide range of profitability. That's why most investors who will approach a short strangle will instead use an iron condor with the weekly options or with the standard options, because in the iron condor I might still have the same short put and the same short call, but on the outside I've purchased a long call and a long put that's further out of the money, so my risk is limited. And when we go into the iron condor, we'll talk about that a little bit more. Now, some of the techniques and strategies that you might be able to have fun with that might be more advanced using the weekly options are, for example, collar spreads. A collar or long collar is typically defined as any position where you buy stock, sell a call, and buy a put. Now, for those of you who are familiar with my trading style, what I present and what I discuss during the other free webinars we host during the week, I'm a fan of using what are called standard collars. And a standard collar is, again, let's say we have our stock trading at $49 per share. I'd buy shares of stock at $49, sell an August 50 strike call that's just at or slightly out of the money, and at the same time I might buy the August 47.5 put or the August 45 put, depending on my preference for risk and reward. So I have the same month to expiration. I've sold an at to slightly out of the money call and bought an at to out of the money put. Well, if the premium's good, I could do that with a weekly option. I could buy shares of, let's say, Barrick Gold today. I could sell the 100 call. Barrick Gold, I'm sorry, is roughly around $97 per share. So I might buy shares of stock at 97, sell the weekly 100 strike call, and buy the weekly, let's say 95 put or 90 put, depending on my risk-reward tolerance. But you can also do sort of a hybrid collar where I could buy, let's say, shares of Barrick Gold at 97, buy the standard August expiration that expires in about 29 days, the 90 strike put, and sell the weekly call against it month by month, or week by week by week. So I've got the standard August put option as my protection, and I'm selling the near-term weeklies every week to generate premium rather than selling the August call right away. Now, calendar spreads, naturally this applies to that as well. A gentleman I had a discussion with at the OIC at 888options.com, he said that one interesting thing he's heard is using calendar spreads. Now, I don't know how many of you are familiar with horizontal or diagonal spreads. I would prefer to do this with diagonal spreads. In a diagonal calendar spread, I would treat it similar to a covered call, but what I'm going to do is if Barrick Gold again at $97, I might buy the far out in time, let's say January 2011, in the money call. Let's say the 90 strike call or the 95 strike call. So I'm in the money and I'm far out in time. And at the same time, I'm going to sell that at or out of the money August call against it. And my hope is that the stock kind of stays right around 100 or a little bit below 100 at August expiration. I keep most of the premium for the call I've sold, and then I'll go ahead and sell the September 100 call or the 105, depending on where the stock had moved to at that point. Well, could I use a calendar spread by, let's say, buying an August or September call on Barrick Gold that's in the money, and then trying to sell the weekly option against it, the out-of-the-money or at-the-money weekly option, every 7 days? Well, yes, I could. We could do that as well. So there are different variations that you can use, but you really want to focus on the income-generating strategies if you're going to use the weekly options, in my opinion. Of course, you can use the long positions as well, but I just don't think you have enough time for the stock to move in your desired direction or the index to move in your desired direction to make a decent premium. All right, so how do we identify weekly options on power options? Well, the first simple way is we can just use the options chain. We can pull them up by symbol just to view the weekly options that are available. We can use the search by symbol tool in a given strategy to view the different combinations on a weekly option, one stock at a time, or we can use the search tool to really customize the positions and the criteria that we want to use for the weekly options in our strategy. And then, of course, we're also going to use the portfolio tools to track the positions just as we would with any standard expiration option, view the rollout opportunities and potential income methods or adjustments as we get closer to our weekly expiration. So let's go ahead and apply that. Let's navigate over to the Power Options tools. I'm just going to pull up our webinar account here, the main trial account. Now I've already selected on the top of my screen just to have some of the basic income generating strategies we discussed available. Covered call, naked put, our two vertical credit spreads, the iron condor, and of course we talked a little bit about the collar and the calendar call. With using the screening tools, I'm going to focus mostly on the credit spreads and the iron condors, and then I'm going to talk a little bit about what we discussed with the collars and the calendar calls. But when we started, if I just wanted to look up the weekly options on any of the available stocks or the indexes, to start, we'll just type in the symbol field. So let's go ahead and pull up $SPX. This is the S&P 500 index, and we want to use the $ on power options. And I'll simply click chain. So this will take me to the 5-strike call and put chain for the S&P 500. And you see we have our various weekly options. Here are calls. And over on the right we have our puts, the different bid price versus the ask price, the implied volatility, and some other information is selected here as well. The percent naked yield. This, by the way, is one of the reasons, and we'll take a look at that at the stock. While naked puts and covered calls can be used with the weekly option, but the yield is smaller. Now, if I do this, for example, we have a 0.4% naked yield. This is if I sold the 1100 put option on SPX as a naked put position. Now, if I did that 4 times in a row, I might have a yield of 1.6%, and that is for the 1100 position. But you see here, if I just went ahead and sold the August directly with 26 days to expiration, scroll down a little bit further here, the percent naked yield for the 1110, oh, I'm sorry, I'm looking at the wrong one, aren't I? I apologize. Here's the 1100. That's the one that has the 0.4% naked yield right now. The 1100 standard August has a yield of 1.5%. So I might be able to sell this one 4 times and get a return of 1.6% if I'm able to get the same premium, which is slightly better than this. Now we'll look at better examples of comparing that in some of the other strategies. But this is just one way that we can look at the basic weekly options that we have and the standard options as well, just linking to the chain. We could also do this for the stocks. And I'm going to go ahead and pull up one of the recent stocks. Let's go ahead and pull up POT, Potash Corporation. And again, this will take me to the standard 5-strike call and put chain. So here are weekly options, and with Potash trading right at around 97.65. Oh, I apologize, I got confused. Earlier I was talking about Barrick Gold being at 97.65. I meant Potash was at $97 roughly when we were talking about those collars. Well, we see here that the slightly out of the money 95-strike put for Potash is trading at about $1.23 premium, $1.30 ask price. This would have a yield of about 1.3% for 4 days or so. Now, 26 days to the standard August expiration, our yield on the 95 put would be 2.9%. Well, if I could do this 95 put, and I expect the stock and the volatility to remain around the same price, and I'm able to get $1.23 3 times, I get it for this week, and then I sell it again for next week and collect another $1.23, I'm almost right at the premium I could get for selling the standard August expiration. Then, of course, if I go further and we'd have 1 more week left, I sell another $1.23. Well, now I'm at about a premium of $3.80, which is much higher than I'd get for the original or the standard 95 expiration. So before you do a weekly option in a given strategy, you want to compare it to the standard option and see which one gives you the best bang for the buck. And again, 98% of the time, if you're assuming a standard price and a consistent volatility over the next 3 or 4 weeks on that particular stock or security, you'll get a better return if you go month by month by month. Now, let's go ahead and just take a look at what we described earlier. We can also see this. I'm going to pull up all months for the time being on Potash. And what I'm going to do is actually go, let's see, we have 26 days until August expiration. Let me think, 5 times, yeah, the December is almost 5 times the amount out in time. It's 145 days out. So I'm going to go ahead and select to hold my December position. And let me just select August, and this will pull up the August and December chain for me because I requested to have December held. Now, we see here that the 95 strike put again for Potash has a premium of $2.74, a 2.9% yield for 26 days. December's expiration is 145 days out in time, so we're about 5 times further out with the December option. Almost 6 times really, but we'll just stick with 5 times there. And we see that the premium for the 95 put is $7.60. Well, if I'm selling a put, it would make more sense to sell this one month by month by month to get a higher annualized return. But if I was looking to purchase a put, I might be better off purchasing the farther out, the December. We're not 5 times the cost here. Yes, we went up $5, but the December 95 put is not trading at around $11 per share, or per contract it's only $7.60. I just wanted to reinforce that idea because that's the same thing we're talking about with the weekly options. When we compare the July week to the August expiration, assuming that potash stays right around $97, $98, it stays within a trading range, and volatility remains around 0.60 or 0.59. Now this is actually quite high. That's another thing you would want to look for. This is our implied volatility, sort of the measure of risk on the position. Now we notice here that the weekly options for potash are almost twice, not quite, but almost twice of our implied volatility for the options in August, just 26 days away. Why is that? Is that a trait with the weekly options, or is there something coming up between now and Friday, July 30th, for potash? Well, let's take a look. As you know from the screens here, we'll use those more information buttons, and I want to link to research. This will give me all the available data that we have for Potash Corporation. And here we see our problem. That premium for the Potash 95 weekly put at $1.23 looks pretty high, and it is. But the reason why is because it is inflated. It has almost twice the implied volatility as the August options. Why? Because the next earnings for potash are coming out on July 29th, Thursday, probably after the market closes. So that means that when we're doing that comparison, if we see a range of implied volatility that's extremely high in the short term in the weekly option, almost twice as much as what it is for the standard August expiration, there might be an event coming up, and since we're in the earnings season, you want to keep your eye out for that. This might not be a great position to choose because we can't control if there's going to be a sudden gap up or sudden gap down on the position. Now, those of you that might be slightly more advanced, options traders, you've been trading for a while, you might look at this as a perfect opportunity to trade a calendar spread using the weekly option as your short-term option and the August as your long, rather than buying an option that's 6 months out in time and a horizontal or diagonal spread, or even 3 months out in time, and then selling the near month. Some investors might look at this as an opportunity for the volatility skew to sell the slightly out of the money 95 put, I should say calendar put spread. I think I said calendar call, but I meant calendar put. And at the same time, maybe buy the in the money 100 or the at the money 95 put to do a horizontal spread. Why? Well, when you have a volatility skew, what you're hoping for is that this option's premium and the time value will decay much faster, and eventually the implied volatility will drop back down to the normal. That's what some calendar spread investors will look for, particularly the horizontal calendar spread investors. So that's just one of the things that you can do directly at the chain just to compare these two different ones. But the theory that we want to reinforce here is that, yes, you can simply look up what's available on the indexes, ETFs, just by using the chain, but you can also look for trading opportunities on the chain, comparing the implied volatility of the different months. And of course, we want to reinforce that when we're doing income generating strategies, it'll work to our benefit to be in a shorter term because we're not giving the stock or the underlying security as much time to go against us, and we'll get a higher annualized percentage return. If you're considering selling a covered call or you're considering selling a naked put, if you wanted to compare the annualized returns, the annualized percent return if assigned from a weekly to a monthly, or the annualized naked yield, simply click on the See More or Less Columns button on the chain, and this will take you to the configuration page. And for my put information, I'll just scroll down, and I want to see the percent naked yield annualized for selling it as a put. And for the call side, which is on the left, I'm going to select percent if assigned annual so I can compare the returns as well. We'll click down at the bottom, select Save and Return. It'll just ask us that so it can refresh the page. There we go. And what we're shown, now it's a little bit exaggerated because, of course, percent annualized yields always can be a little bit exaggerated. And what we're saying is we're expecting to get this $1.23 every 4 days if we were looking at the 95 put. We know that's not going to happen. Why do we know that? Well, because on July 30th, after the earnings date has come out for Potash on 7/29, the next week, the new option that's released is not going to have as high as an implied volatility because there's no earnings event to inflate it. But if we were able to get this $1.23, let's say, every 4 days in a naked put, we'd have an annualized yield of 118%, as opposed to using the standard August expiration. If we get $2.74 every 26 days, we'd have an annualized return of about 40.5%. Both are extremely good, of course, do not get me wrong, but this will help you just compare. Again, if we were, and again, I don't advise doing this, but let's say we did the covered call on Potash by using the 100 weekly. Well, if we were able to get $1.18 by selling the out-of-the-money 100 call and the stock moved up to 100 and we were assigned, our annualized return would be 334%. If we were able to do it every 4 days, of course, as opposed to 75% for using the covered call. Of course, we wanted more safety and we went in the money or at the money and sold the 95 call. If we were able to do that every 4 days, receive 375 for the in-the-money covered call at the strike of 95, we have an annualized return of 107% or an annualized return of 40% if we just use the standard August expiration. All right, so that's the chain. You can customize it any way you want to. You can select to view the weeklies. Look in July, for example. Now, what I also want to do is let's go back in time a couple days. And I'm just going to use the previous button here. We're going to go back to July 23rd, which was on Friday. And what we see here is that let me go back one more day. I'm sorry, July 22nd. Should be there. Okay. Oh, this one didn't have it. I'm sorry. Well, this is the Thursday, July 22nd, and this was the first day that the new weekly options for Potash were released. Let me go to Apple. I'm going to go to Apple on July 22nd because remember the weekly options for Apple started on June 25th. So on July 22nd, if I would have pulled the chain up after the market close on Thursday, July 22nd, I have the July weekly options that are expiring one day. So on Friday, July 23rd, we had a set of weekly options that were set to expire. But then the new options were also released. So I have the 1 day left to expiration, and then close of the market on Thursday, the new weekly options were released. So I have 1 day left for my first July series, and now we have the new July series that has 8 days left. Why is it important to show you that? Well, if you have a stock that you're trading in this fashion as a covered call or maybe even as a calendar spread or a collar perhaps, maybe even as a credit spread, when you get to the point where you're looking to maybe roll the position, let's say you originally sold this 270 call for 85 cents and it's now trading at 7 cents, Thursday afternoon is when you might start looking for the new options to be released. See, this is when you'd consider rolling it on Friday morning. You don't have to hold it all the way to Friday expiration. Friday morning or maybe Thursday afternoon, if these are released early, you could look to liquidate your position and look for rollout opportunities using the new weekly series that was released. So that's just important to know that when you see those on Thursday afternoon, that's when you might want to start comparing your rollout opportunities if you're using a weekly strategy. Okay, so we talked earlier about the income generating strategies. This is the chain where you can look at the different weeklies that are available. But if you really want to get into a strategy analysis, we'll just click on the strategy tab. Let us go ahead and start off with bull put credits. And for a bull put credit spread, of course, we see our standard profit and loss chart over here on the right. We're going to sell an at or slightly out of the money put, and we're going to buy a further out of the money put. We're going to generate a credit because we're going to receive more for the put that we sold, and our goal is to have the stock remain above the put strike price so both puts expire worthless and we keep the net credit. Well, let's say I'm interested in doing a weekly series on, let's see, I've picked on those stocks already. Let's just say, I'll go with ExxonMobil. So I'll go ahead and click on search by symbol. I can type in XOM. Now I see that I have an August series here, but I want to change that to July right now. Why do I want to change it to July? Well, because these weekly options are going to expire on July 30th. Now next week what you'll see in that drop-down menu, after Friday expiration, what you'll see next week is you'll have an August weekly selection and then the standard August selection as well. So you'll be able to view them individually through the month selection. But since we're still in July, it makes it easy. We'll just select the July option. We have a couple of spreads here. With the stock at 60.39, we're shown the at-the-money spread. We could sell the July 60 put for 41 cents and purchase a July 57.5 put for 5 cents. Our total net credit would be 36 cents, and we're risking roughly $2.14. The risk is the difference in the strike prices between 57.5 and 60, but since we keep this 36 cents regardless of what happens, our true risk is only $2.14. Now we only have a 62% probability, even in the next 4 days, of ExxonMobil remaining above 60. That might be a little tight. Let's go ahead and open it up to all results and see what we have here. Okay, here we have, nope, we ended up getting some in-the-money puts, which we wouldn't want to see. Now you might look at the returns and say, oh, I'd really like to use this 62.5 put that generates a 212.5% return. Well, we all would. The problem here is you only have a 5.1% probability of the stock trading above 62.5 in the next 4 days and earning that return. Not really a good approach to use. So we would probably just drop down to those more results there and focus on just the slightly out of the money positions. Now you may ask, well, where's the 57.5 put and where's the combination of, let's say, selling the 57.5 put and buying the 55, which would have a better probability? Well, right here you can tell the bid-ask spread. This is the ask of the 57.5, so the true bid might only be 3 cents, and the ask here for the 55 put is 2 cents. So we might have a rough problem there generating any kind of worthwhile credit, even for a weekly option. But we can look for those on the search screen specifically based on what we want to see. And I think that's what a lot of you are interested in doing, is how to use the search tool in any given strategy to identify a weekly position. Let's go ahead and take care of that. I'm going to go into the search screen. When we're dealing with weekly options, whether it's in a credit spread, an iron condor, a collar or a calendar call, or even a covered call or naked put, we have to take a few things into account. The most important being we shouldn't expect to look for credit spreads with the weekly positions that have $1 in premium or $1.50 in premium, maybe on the indexes or some of the higher price stocks such as Apple, but we're going to have to expect smaller premiums. Now the return is still going to be very valuable. The return is still going to be good, but because we're in a much shorter time frame, we're not going to be collecting a lot of premium. So with that as a background, when I pull up a search tool and I want to create a screen to search for weekly options in a given strategy, what I'm going to do is scroll down to the very bottom, and I'm going to select the button the very bottom of the search parameters for clear these settings. I want to empty everything out. Okay? Now what is our first step? Well, I'll take a look at the option expiration time frame in the upper left hand side. I could select July right now, or I can leave it in all months. And when we get into August, you could also select August, but the really important thing here is to limit your days to expiration. So I'm going to put in a days to expiration of 0 to 5. I'm going to screen for all months, but only look for positions that have an expiration less than 5 days away, our weekly options with less than 4 days away. Now I'm doing a put spread, so one of the important things, I want to make sure I'm at least, to start off with, at least slightly out of the money. So to start, I'm only going to look for positions that are at least 2% out of the money. Got to have at least a 1% return. This is just to start with. We can customize this later, but keep the search basic. Then for now, well, one other thing that I'll put in, even with weeklies, I probably won't trade a bull put or a bear call credit spread unless I have a probability above at least 65 or 70%. So I'm going to start it off simple, just a small range out of the money, minimum return, and a probability of greater than 65, just looking for those positions that are between 0 and 5 days to expiration, and then we'll click Submit these settings. Wow, well we got a lot of combinations here, so there's some really good stuff in here. I have this sorted, by the way, by highest probability to lowest. So we see we have some positions with a 98% probability, small return, net credit of 2 cents, 3 cents, 5 cents, 1.3% return, for example, 1.5%. Okay, well, at least we know we have some good results starting from scratch. So let's go ahead and enhance our search filters. Well, I'm going to first increase the probability. I want to make sure that I'm getting a probability of at least 75% or higher. This means that the stock, of course, or the ETF or index will remain above that short put strike price. Okay. Range out of the money, well, they go hand in hand. The further out of the money I am, the higher probability I'm going to have. But let's go ahead and say at least 5% out of the money. We want to tweak that return a little bit too. 1% is really good for a weekly position, but let's increase it. Let's force it to be at least 2%. And again, we'll talk about net credit. Maybe we just want to make sure that we're receiving at least 30 cents of net premium. Okay, so let's see what our results are now. Let's go ahead and click Submit. Ooh, okay, we went too far. Probably the range out of the money and the net credit combination. So let's go ahead and reduce that. I'm going to go ahead and just put that back to 2% out of the money. I'm going to leave my percent return at, now let's lower that too. Let's just put that at 1.5 and a net credit of 30 cents. Let's lower that down to 15. You see kind of the problem you might have with these weekly expirations. Got to take, there we go, okay. We want to take some of those things into account. So now I've limited it to only 46 results. And we have some bull puts on potash using the 90 and 85 and the 90 and the 80. Our percentage returns, these are relatively low, but we have to keep in mind what that means. This is for example, a 4% return on potash in 4 days. The annualized return on that would be pretty decent, again, assuming we could get that every 4 days. But you notice our net credit here, the only one that has a net credit close to $1 is our SPX bull put credit spread, where we have the the index is at 1,115. We could sell the July 1,075 put for $1.20 and buy the July 1,025 put for 20 cents. We'd get $1 net credit. Oof, but that's disgusting. The maximum risk there, I should have put that in as 49 because it's a 50-point spread. It's tough to try to look for a position that would make $1 to risk 49, isn't it? Even though the probability is high at 96.4%, that's a little bit tough to swallow. So when you're in the bull put credit spread, bear call credit spread, the debit spreads, or the iron condors, you'd want to filter your maximum risk there. So let's just make this less than 15. I don't want to see any spreads that have a risk higher than 15. Let's run that again. This will probably cut 1 or 2 spreads out of the position. Oh, we cut out about 10, so now we're down to 46. And we have a decent mix of all of our weekly components, don't we? As we can see here, we have some of the stocks. We have Potash, Amazon, Google, Baidu, of course. We have our indexes. Here's OEX, XEO. We have our ETFs. Here's GLD, the gold shares, SPY, and did I see another one in there? I thought, oh, FAS is the 3 times ETFs. Okay, well that's interesting. What if we just wanted to see the credit or debit spreads on the stocks, for example, without the ETFs? Well, let's just scroll down again. At the very bottom in the center section of every strategy, you have the recommended list field where you can look specifically to identify positions just on certain ranges. So if I wanted to see just the bull put credit spreads on the indexes, ETFs, and holders, we'll just select that list. I'll click Submit these settings. And now all of the stocks are filtered out for us, so we just see the 20 results on the different indexes and ETFs for weekly bull put credit spreads. Now if I wanted to reverse it and just look at the bull put credit spreads on the stocks and not the indexes of the ETFs, well, I'll select No Lists to keep it open to the whole universe of options in the recommended list section. And then in my Remove List field, we'll select indexes, ETFs, and holders. So I'm going to remove all of the indexes and ETFs, and then we'll click Submit again. And now we're going to see just those stocks that have weekly options that match that criteria. But there's another small thing we want to consider. Remember when we were looking at the option chain, and we saw that on our potential potash position that those weekly options we were viewing were highly inflated and had almost twice the volatility because there was an earnings coming out on July 29th. Well, if I'm doing a credit spread, whether it be a bull put or a bear call or an iron condor, really if I'm doing any income generating strategy, what I want to make sure is that I'm looking for stocks that do not have earnings between now and expiration. Even when I'm doing a weekly strategy, I want to see that. So we'll scroll down to the bottom here. You have your earnings date selection on the left-hand side. Let's tell the system we just want to see bull puts on those stocks in addition to our other criteria that do not have an earnings date between now and expiration. Let's go ahead and click Submit. And what are we going to get now? Okay, so we filtered out Potash and a couple of the others. We're left with bull puts on Amazon, Google, Apple, Baidu, Goldman Sachs, and then we can compare the returns versus our probabilities as well. Of course, as you get into the lower probability of success, you see the higher percentage returns, and the higher percent probabilities, you see the lower percentage returns in net credit. Well, that's just what you'll see in any given strategy. Greater the probability of success, lower the return. Higher the percentage return, the lower probability of success. All right, so that's just a brief intro into the bull, how you would use this for the bull puts, the bear call credits, even the iron condors. When you're doing a weekly search, or a search for weeklies in any given strategy, remember, hit clear these settings first and start off with just the three or four basic components. Make sure you set the option expiration time frame first. That's most important. You can use all months. You can use the direct month for July, or I could even select, see right now I couldn't select August. If I selected an August expiration between 0 to 5 days, it couldn't find anything because we're still in the July series. But after Friday, you could select August now. You would select August for the month, but limit your days to expiration to 0 to 5. That's the most important. Now for a credit spread or an iron condor, use your range out of the money, a very basic, maybe 2% out of the money, just to make sure you're only looking at positions that are OTM. If I'm doing a debit spread, of course, I might look for positions that are at least 2% ITM in the money. And then put in a basic value for your percentage return. Start off maybe with just 1%. If you do have a requirement for a minimum net credit, put that in as well. And then, of course, your probability. Start off with something low, maybe 65%, and then increase it depending on the number of results you get. Of course, if you're screening for an iron condor, you wouldn't have a probability above or a probability below as you do in a bear call or a bull put. What you'd be looking for is the percent probability between, and that's the theoretical probability that your underlying security would remain between the two strike prices. And all four options would expire worthless. Now I'm going to go into the collar spread very quickly, and then we'll jump into the portfolio tools. I'll just show you some basic stuff there, and then I'll take some questions. But with the collar search, we have something a little bit different that we want to apply. Now remember, this for a collar and a calendar call spread, whether a horizontal or diagonal or a calendar put spread, we're going to put in ranges for what we want the short option to be. Now I can use the standard collar, of course, with the same expiration as we're seeing here with Baidu with the September calls and the September puts, for example. We talked earlier about those collars, those sort of far out in time or further out collars, and also the calendar spreads where you might want to use the standard expiration. We would set this up the same way. I'm going to go in and hit clear these settings first, but now I have two options to contend with. For the collar, the call option that I'm selling, well, I'm going to leave it at all months. I'm going to select 0 to 5. For my put expiration time frame, I'm just going to select August, the standard expiration. Because I've selected this, I do not have to use the call expiration date to be greater than or less than the put expiration date, for example, because I've already told the system what I wanted to see. Now I want to make sure that my call is at or slightly out of the money, so I'll put my call percentage out of the money, 0 to blank, and my put, maybe I want that to be at least 2% out of the money as well, because I'm using a standard collar. I'm not using a radioactive trading setup where we use in the money puts. I'm just referring to a standard farther out in time collar. Now for the total net premium, again, this is the difference between the call and the put. Let's say I want to make sure that I'm getting at least 15 cents of net premium. I don't want my risk to be greater than 8%. And of course, I'm going to want a percentage of assigned of at least 1%. So again, basic 5 or 6 criteria. The main thing is the time frame. I'm going to look for a potential collar where I'm buying the August put. Ooh, I just realized something. I have to take this one out. And I'll explain why. In a standard collar, if you're using the same expiration, you'll be able to generate a net premium because the call that you're selling will be higher than the put option that you're buying. But if I'm doing this type of setup where my put's further out in time, I probably won't be able to generate a premium. It'll actually have a debit between the call that I'm selling and the put that I'm buying. So let me take that out before I make that mistake. And I'll just use my shorter time frames here, my maximum risk less than 8, my percentage if assigned of at least 1. And here we go. We have some ETFs here, good positions. There's 130 total results. Well, that's pretty good. And you see here my net premium column. These are all negative values because I'm going to be paying more for the put that expires in 26 days than I'm going to be receiving for the call in 4 days. Now I would approach this type of collar the same way I'd approach a diagonal spread with this setup. If, for example, instead of doing this collar, let's just take this example here that I've highlighted. Gold shares at 115.52. We'd sell the 117 weekly call for 34 cents, 4 days to expiration, and buy the August 112 put, out of the money put, for 95 cents. Okay, so this would yield a potential return if assigned of 1.2%, not that great, but I'm only risking 3.6% if the stock moves against me. But what I'd look to have happen is the stock stay right around or below 117 by Friday. I'd want this call to expire worthless, and then I'd look to sell the first week August weekly option, maybe the 117 or the 118, depending where the stock has gone, and maybe collect another 34 cents. Well, let's compare this very quickly. This would work when you're doing, if I'm doing this type of collar, I'd want to compare it to the diagonal calendar spread, which is almost essentially a parity trade. So let's go ahead and take a look at the profit and loss chart for this position. Okay, so don't have a lot of return, $137 or 1.2%, but keep in mind that's the maximum return we'd make if the stock, or the ETF in this case, was trading at 117. And 1.2% for 4 days is not that bad of a return. You shouldn't expect a whole lot more than that when doing a weekly position, for example. And our maximum risk is $414. We're buying stock, we're selling the weekly 117 call, and buying the standard August 112 put. Well, sort of parity trade to this would be doing a calendar spread. So remember, we can make 137, and we're risking 414. Let me just jot that down real quick for this position. 137 and a risk of 414. Okay, great. I'm going to scroll back up on our profit and loss chart, our custom spread tool. We're looking at the August 112 put. Well, stock and the August 112 put is very similar to still selling the same 117 call, but maybe buying the standard August 112 call as a calendar. So I pull up the chain, and I'm going to select the 112 call. That'll automatically add it to my position, or the next available line. So now I'm going to look at buying the August 112 call and still selling that. This is going to create a diagonal calendar spread for us. I'm not going to put in a price. It's going to grab the natural ask price for me. So we'll go ahead and hit submit. Okay, well, the parity trade is not as good, is it? Remember, when we did the standard collar, yes, we'd be putting out more capital, but with the standard collar setup, or that, I'm sorry, not standard collar, but with that collar setup, we're using the August put and the near-term weekly call, we could have made a profit of 137 max, or a risk of only 414 as opposed to a risk of 421. And remember, because this is a leveraged position, that $421 is 100% of our investment. We're risking 100% on this calendar spread. Whereas in the collar, we had the same monetary risk, but it represented only 3%, 3.5% of our total cash investment. Of course, when we're talking about that, we can also see this is a 30.9% return. The 130, if we make the maximum profit off an investment of 420. Leverage works for you and against you, but we all know that. But this is just another way you can use the profit and loss chart to help parity trades using the weeklies or building different weekly positions. Just by going up to the top and clicking the View Options field and selecting the weekly spreads or the different months, you can quickly compare, build your positions, and compare your risk versus reward. Now, if I decided I wanted to track this position, this was something I was interested in trading, this little calendar spread on GLD here, I can select to add this to portfolio right from the screen. I could have also done that from the search menu. Remember, we could use the more information buttons to just go ahead and select add to portfolio. When we select the portfolio menu, we're going to be asked which portfolio do we want to add this to. If you haven't created a portfolio, you just have a selection here for new portfolio. I created one earlier today for the weekly positions. So I'll click on weeklies. Let's scroll down here, make sure everyone sees that. So I'll just click the radio button for my weeklies, and we'll select insert. And here is, I can add other positions, but this is exactly what I wanted to see. I'm going to buy the August 112 call for $4.55, sell the 117 at 34. This expires in 4 days, and that little W there, that's our weekly signia, so we know it's a weekly option. Let me click submit. I'll go ahead and open this up to full screen. Now we see we have a couple positions already entered. Well, here's our calendar spread. We're long that August 112 call. We sold July 117 call. We have our prices that we paid, and we see the current liquidation prices. Just as before, as your regular positions, when you scroll over, you see your original expected gain. Remember that 30.9 or 30.8%. Where our position stands right now, due to the bid-ask spread, I have a loss of 3.1%. And if we held this all the way to expiration and GLD remained at the same price, it would only be about a 2.9 expected return from the remaining value of that long call. And of course, the short call would expire worthless. Now, I have some other positions here. I put in quickly just a comparison of the two collars using the July 100 call, the weekly option on Potash that was entered on the 23rd. And there's that August 90 put. And then here's a standard collar position using the July 100 call and the weekly 90 put. Now, I used the actual prices on 7/23. It was the closing prices on 7/23 for these two positions. Now, if we scroll over, we see something kind of interesting, that the two positions, even though on one of them I'm using the weekly put that expires in 4 days as a standard collar, and the other one I'm using that farther out August collar sort of as a diagonal setup. Well, my original percentage return in monetary value for both of those two collars was about the same, 276 versus 288, or 2.8% to 3%. Right now, we have a smaller loss, only a 0.2% loss, or $24, on the position that's using the August put as opposed to the standard put, because the standard weekly option is probably decaying faster percentage-wise than the August option. And if the stock remained at the same price to the near-term expiration, we would have about a 1.2% profit on the first collar that's using the August put, and a 1.3% potential theoretical return on the weekly position. Now, for the naked put position we just put in a basic put here. We were looking at ABX when it was released on July 22nd, July 23rd. We were considering, let's say, selling the July 41 put. Well, we originally received 42 cents. Of course, it's moved now to 42 cents as well. As many of you know, what is one of the most powerful features of the Power Options Portfolio tool is that we can use the More Information button, select Position Actions, and then Position Analysis. And this will give you a breakdown of where your position stands right now. Of course, we don't have much gain or loss in this position with only 4 days left to expiration. We are down to less than 1% of time premium. Didn't have a lot to begin with because it's a weekly option. But if we scroll down further, let's see if we have anything. Yes, we do. We're given the breakdown of our original position, our current liquidation value, and our future expiration value if the stock stays at the same price, about 1%. But then further below, just as we would see with any standard expiration series, we have potential rollout opportunities. So if we feel the stock is going to stay above the put strike price, we could simply let it expire. It's going to give us a definition there. But if we consider that ABX might move up in price, we could consider buying the close of July 41 for 42 cents, not really a gain or loss right now from our original premium. And then we have some rollout opportunities. We could go to the August 40 put for 68 cents. The adjusted naked yield would be 1.7%. Remember, we have 1% right now if the position expires. That was our future expiration return. We could double that for August by going to the 41 put, the same put but 3 weeks out. This would give us an adjusted net credit of 102. So just as you could with standard options, you'll be able to see these rollout opportunities, these potential adjustments on the weekly positions. And if I wanted to compare a potential rollout to the existing position, we'll just use the More Information button in the portfolio to go to Simulate Trade. And here we just see the basic positions. We could just theoretically make 1% on our weekly position. if we leave it open through Friday and the stock remains above 40, and then we'd look to sell the 1st August expiration, or maybe we'll roll on Thursday. And if we rolled now to the standard August expiration, we can increase this gain to about 2.6%. Well, remember what I said earlier on in the presentation. If you're finding yourself in a pattern where you're really comfortable trading these weekly options as a spread, as a naked put, for example, in a collar position, or especially in the diagonal calendar positions, you typically might want to wait for that Thursday before your weekly expiration to start evaluating the rollout opportunities, because the new weekly series won't be available until then. If I pulled up this position on Friday morning, I would see potential rollout opportunities for selling for buying the close this existing put, which expires on that day, and then rolling to the new Friday series that had just come out that expires in 7 days. So you want to make sure that if you're doing the weekly series, it may be a good idea to wait to Thursday, unless, of course, your position is threatened and you want to make the adjustment early. All right, well, that's the basic discussion. I'm just going to go ahead and navigate back quickly to our slide presentation. And keeping up with the new releases going forward, if you follow the blog on Power Option, http://blog.powerup.com, we'll post the new listings each time they're announced for the weekly options. Those new 5 stocks that were released Friday, we actually haven't put those up yet. We'll probably put something together later this afternoon. Here's the link for the CBOE site I was referring to that we looked at a little bit earlier, cboe.com/micro/weeklies/introduction.aspx. Send me an email later if you'd like that link so that you can reference it on cboe.com. You can link to an Excel spreadsheet that gives you the listed weekly options on the exchange and the new ones as well. And of course, a third way that you can keep up with the new releases is that once you create a basic search for the weekly options, every time you come in and run a search, you'll be able to see which stocks, ETFs, or indexes appear, and that'll give you a good gauge of what has weekly options available right now. Just as a review of the Power Options subscription services, 20-minute delayed service is $59.95 per month, or discounted rate of $600 for the year. We offer the real-time service, which is $79.90 per month, or the discounted rate of $800 for the year. You can get a 3-month historical data selection on top of these 2 subscriptions. The historical data is not included with the 20 minutes later, the real time. But if you're already on the real time, it's actually cheaper per month just to upgrade to the professional level of service at $99.99 per month. Gives you all the real time and unlimited access to the historical data, or $1,000 per year. All right, I went a little bit over and I apologize, but I have no problem staying a little bit longer. Chuma asked about, can you go through the how to search for calendar spread? Sure, it'll take me a second because it's exactly the same thing I just did in the collars. All right, so if I wanted to do a calendar spread, I really apologize there. Hold on one second. I actually shut down that whole screen. I'm sorry. Oh, I see what happened. You know, sometimes the internet does stuff for you when you don't want it to. Apparently Firefox was just downloading some new updates and it decided to close on me. So let me pull up Power Options again. Just give me 1 second, Chuma. Ugh. Always fun, isn't it? All right, let's log into our account. There we go. All right. So we would do the same exact function, Chuma, we did when we reviewed the collars. I'll go into calendar call. This is showing you a profit and loss chart for a diagonal, which, by the way, again, I prefer to use diagonals over horizontals because if you can, horizontals are essentially picking the strike price, you know, a 10th profit and loss chart, sort of an A profit and loss chart. And if you can consistently pick stocks that in the next 5, 10 to 30 days are going to be trading right at a strike price, you probably don't need my help. But we'll go into the search screen for the calendars, follow the same 1, 2, 3 steps, Chuma, that we did for the other strategies. I'm going to scroll down to the bottom, not even paying attention to any of the settings. I'm going to hit clear these settings. Now let's say I wanted to set up a diagonal search similar to the one we compared with Potash that we ended up putting into the portfolio. What I'll do is the near month, this is for the call, the near option month, I'll select all months for now, and I'll just go 0 to 5. To keep it more simple, I could also select July, but the reason I use all months in this case is because if I save this search, it's going to use that setting every time, so I don't have to worry about is it looking at July or is it trying to look at the month before, is it looking in the current month. I know right away that it's always looking at all months 0 to 5 days to expiration. And if I was going to do a diagonal position where I was using the weekly option but the standard expiration that's just 3 weeks out in time, 4 weeks out in time, we'll select August for our FAR option expiration time frame. Again, I'm sorry. Hold on one second. Something just happened there. Got to be kidding me. All right, let's try this again, shall we? I'm really sorry about that. It's doing some automatic Firefox update. Let's try that again, shall we? Calendar call. Go into search. Let me scroll down to the bottom and hit clear these settings. Fantastic. August time frame. We'll go all months 0 to 5. And I'll select August. When looking at a diagonal, my near-term call, I want it to be out or out of the money, so I'll start off with a basic screen for % out of the money, 0 to blank, that's for the call that I'm selling. And for the put option, I'm going to want to be at least maybe 2%, probably even higher than that, but we'll start off with that basic search again of 2% in the money. Okay, so now what we'd want to do is maybe I want to make sure that I receive at least a 1% return if assigned. The net credit, that's actually the net debit. I'm not going to worry about that right now just to see what's available. And then if I wanted to, I could screen specifically by the implied volatility ratio, the delta ratio. Let's say I want to use that. I want to use a delta ratio which compares the long option delta, the delta that I'm buying, to the short option delta. I'm going to have to look for a minimum of 1.5%. Or delta ratio of 1.5, I apologize. So let's go ahead and submit these settings and see what we get. All right, so here's some of our positions there. You see that we're selling the July short-term call, minimum premium of 5 cents on this first one, and we're buying the August in-the-money call on FAZ, show our potential percentage return, net credit, for example, the number of write cycles. This is how often you could sell the short-term call against it. Now, you can make some small tweaks to this Chuma. Instead of using the net credit, let's say that I wanted my bid price of the option that I'm selling to be at least 15 cents, so I'll just put in 0.15. And again, if you just wanted to see the diagonal spreads on the stocks, I could select to remove the index, ETFs, and holders, or if I just wanted to look at the calendars on the indexes and ETFs, I'd select that from the recommended lists. So let's go ahead and run this search. Okay, see here are all of our stock positions that match that criteria. There's a lot of them in here. So that shows you, Truman, that you could use different settings to further. There's a wide selection of combinations using the weekly short call and the August long call that you could use to help you customize this. You could increase your percentage return, put in a minimum net debit, for example. If you wanted to use open interest and volume as part of your filters, you could do that. I might even increase the delta ratio here to 1.8%. Let's see if I can get anything on that. Typically, that's what I would use when doing a diagonal spread, is a delta ratio of 1.8. All right, so that narrows it down to 69 results. So I can still continue to further screen this, but Chuma, that is how I would use the calendar spread. Follow the same simple steps. Scroll down to the bottom once you access the search, hit clear these settings, and then you want to set your short option expiration time frame first to be between 0 to 5 days, 0 to 7 days, depending on what you are. For example, if I'm starting a search on Thursday, I probably have to use an expiration, short-term expiration, for 0 to 8 days or 0 to 9 days to see the new August positions come in that expire next Friday. And then you set your long-term expiration. You don't have to use August. That's just one thing that the gentleman at OIC mentioned to me, and I thought that was pretty unique. But I could do the same thing with the weekly options and September series instead of August. So we'll just select September, and I'll click Submit these settings now. And see, now we have combinations. Of course, our net debit's going to be higher because we're paying more for that September call. But that gives you a wide range of different variables that you can adjust to identify just the positions, whether they're calendars, whether you're doing horizontals or diagonals. You'll be able to identify them with the weekly opportunities very easily. All right. Do we have any other questions regarding any of the search features for the weekly options, or just general discussion on the weekly options as well? I'll prompt you to go ahead and send those questions in. We are over time, and I thank you for staying with me. Let me just navigate back to, I didn't want that screen. I apologize again. There we go. Of course, if you think of any questions later on, please feel free to contact us at any time. You can send an email to support@powerop.com. You can call me toll-free during market hours at 877-992-7971. Or if you live outside the continental U.S., you can reach us internationally at 302-992-7971. I see Jack says you were having problems with Firefox too. I've never had that happen during a webinar, and I apologize for that, but was able to pick it back up and go through pretty easily. All right, ladies and gentlemen, I don't see any other questions coming in. I want to thank you again for joining us for the weekly presentation. Further on down the road, maybe later in August, we might do a second part of the series. Why am I waiting so long? Well, because I want some time to actually have, I don't want to say an actual track record, but some trading history comparing what would have been better doing a diagonal spread on a particular stock, what scenarios. What I mean is going deeper into the management, deeper into the discussion of is it better to use a standard expiration or a weekly expiration. We already touched upon that a little bit. Theoretically, if everything stays the same, you'll always get a better annualized return using the weekly options month by month or week by week, as opposed to the standard expiration series. But sometimes it might make more sense, depending on your trading style and what you're investing in, to use the standard series. And what do I mean by that? Well, if I'm looking for an iron condor that has a high probability between of, let's say, 85 to 90% on an index or an ETF, for example, or let's just say on an index, even one of the higher price indexes, I might find positions that are offering a net credit of maybe, let's say, 60 cents, 80 cents to $1 with a risk of 15 to 20 points. Okay, so I'm making a decent return, but I have to keep in mind if I want that same combination in a weekly series that has a 90 to 95% theoretical probability, we may only be talking about a net credit of 5 or 10 cents. And with that wide of a risk, or maximum risk or margin requirement, if you can only trade 1 or 2 contracts, that doesn't make any sense to just get 5 or 10 cents in premium. You probably want to stick with the standard expiration so that the premium is going to cover your commission costs and still give you a return that makes sense for you. But we can talk about that later in a follow-up presentation. What I really want to do is have some examples of comparing, let's say I took Apple and I traded the standard covered call against it. What would my return have been if I managed a weekly series on Apple and every week either made an adjustment or rolled the position? Same with the calendar spread to those collars we were talking about, which may or may not have worked out better using the collar with the standard collar with both weekly options, trading that 3 times in a row, or using just the standard expiration that was 3 weeks out to begin with for the call and the put, or using the long-term put that was the standard expiration and selling the weekly calls against it. And rather than use the historical tools to find that, I actually want to trade them and paper trade them in real time so that we can see some of the adjustments we might have made. And as I mentioned, we'll put that presentation together for later in August, probably the 3rd or 4th week in August. All right, well, thank you again, ladies and gentlemen. I hope to see you all soon at our upcoming webinars. Remember, every Tuesday and Thursday at 12 noon, Kurt Frankenberg hosts his Introduction to Radioactive Trading presentations. Every Wednesday at 12 noon, I typically host an Introduction to Power Options free presentation, and every Friday at 4:30 Eastern Time, we usually have the open discussion presentation as well. So I hope to see you all soon at one of those upcoming presentations. Thank you again, everyone. Have a good evening. We'll see you soon. Good night.